Two people, same age, same city, same $50,000 saved. One buys a rental property, one puts it all into index funds. 20 years later, one of them has significantly more money, and it's probably not the one you think. This is the debate that never ends. Ask 10 people which investment is better and you'll get 10 confident answers, usually delivered by someone who has only ever done one of the two. Real estate investors swear by leverage and tangibility. Stock investors swear by simplicity and compounding. Both sides have real arguments. Both sides also have blind spots they don't like to talk about. So today we're going to run the actual math. No hype, no YouTube thumbnail promises. Just what really happens when you follow both strategies for 20 years side by side and count every dollar in and every dollar out. Let's set the scenario. Meet Alex and Jordan, both 28 years old, both earning $55,000 a year, both living in the same mid-sized city and both with $50,000 sitting in their bank accounts ready to invest. Same starting line, different paths. Alex buys a rental property. She uses her $50,000 as a 20% down payment on a $250,000 house, a solid 3-bedroom in a decent neighborhood. In 2026, with mortgage rates sitting around 6.5% to 7%, her monthly mortgage payment on a 30-year loan comes out to roughly $1,330. She finds a tenant who pays $1,800 a month in rent. On paper, that's $470 a month in profit before any other costs hit. Alex feels like a genius. Jordan takes the same $50,000 and drops it into a total market index fund. He sets up an automatic $300 a month contribution and doesn't think about it again. His friends ask what he's invested in. He says index funds. They nod and change the subject. Nobody is impressed. On day one, Alex has a house, a tenant, and a story. Jordan has a brokerage account and a confirmation email. In terms of how it feels, it's not even close. Alex is winning. But here's the thing about feelings and math. They are not the same thing. Let's talk about what Alex's investment actually costs. The $470 monthly surplus sounds great. It's the number real estate influencers put in their thumbnails. It's the number people share at barbecues. Here's what comes out of it before Alex actually keeps any of it. Vacancy. On average, a rental property sits empty about 1 month per year. That's a full mortgage payment with zero rent coming in to cover it. And when a tenant leaves, there's cleaning, touch-up repairs, relisting fees, and time spent showing the place to potential new tenants. Maintenance and repairs. The standard rule is to budget 1 to 2% of the property's value per year. On a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $150 fix under the sink. Other years it's an $8,000 roof that couldn't wait. Capital expenditures. Roofs last 20 to 25 years. HVAC systems last 15 to 20. Water heaters last about 10. These aren't surprises. They're guaranteed future costs that arrive in chunks of $5,000 to $15,000. If you're not setting aside for them every month, you're not running an investment. You're running on hope, property taxes, and insurance. In most U.S. markets, these alone run $3,000 to $5,000 a year, and they go up over time. And then there's the question of management. If Alex hires a property manager, that's 8 to 10% of monthly rent, roughly $150 to $180 a month gone immediately. If she manages it herself to save money, she's working a part-time job with no hourly rate, no sick days, and tenants who don't care that it's 10 on a Sunday night. After accounting for every real cost over the first 3 years, Alex's actual net cash flow is somewhere between $2,000 and $5,000. Not the $17,000 the gross number suggested, and that figure doesn't include a single hour of her time. Jordan, meanwhile, has contributed $50,000 upfront plus $10,800 in monthly contributions. At roughly 10% average annual returns, it's the S&P 500's long-run historical average. His portfolio is sitting at around $76,000 by year 3. He spent 0 hours managing it, 0 phone calls, 0 emergencies. But here's where Alex has a genuine advantage that Jordan can't match: leverage. Alex used $50,000 to control a $250,000 asset. That's a 5-to-1 ratio. Jordan used $50,000 to control $50,000. When Alex's property appreciates, she earns returns on the full value of the house, not just on her down payment. At 3 to 4% annual appreciation, by year 3, her property is worth around $270,000 to $280,000. Her equity, the gap between what it's worth and what she owes, has grown to somewhere between $55,000 and $65,000. That's real wealth created in part by the bank's money. Leverage is the single biggest advantage real estate has over stocks, and it's a genuine one. By year 10, the picture looks like this. Alex's property has appreciated to roughly $335,000 to $350,000. Her remaining mortgage balance is around $166,000. That puts her equity at approximately $170,000 to $184,000. Over those 10 years, after every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, her total out-of-pocket beyond the original down payment is somewhere between $20,000 and $35,000. Her net cash flow after all expenses, modest. Her appreciation-driven equity, significant. Jordan's portfolio, with his $300 monthly contributions and 10% average annual returns, sits at roughly $165,000 to $180,000 by year 10. He contributed $50,000 upfront plus $36,000 in contributions, $86,000 total. The rest is pure compounding. He spent exactly 0 weekends dealing with anything. At 10 years, they're surprisingly close in total wealth. Alex might be slightly ahead because of leverage, but here's the difference nobody talks about. Alex also spent hundreds of hours managing her investment, took on $200,000 in debt, and concentrated everything into a single asset on a single street in a single city. Jordan is diversified across thousands of companies, can access his money anytime, and has never received a 10 p.m. text about a broken furnace. Now here's where it fully separates. By year 20, Alex's property is worth somewhere between $450,000 and $500,000. Her mortgage is nearly paid off. Her equity sits at $400,000 to $500,000. 20 years of rent has come in, but so has 20 years of maintenance, repairs, tenant turnover, insurance increases, and at least one major renovation. Her true net cash flow above all expenses over that period, somewhere between $40,000 and $80,000, depending heavily on the local market. Jordan's portfolio at 10% average annual returns with his $300 monthly contributions has grown his $50,000 to approximately $420,000 to $460,000. Total contributions over 20 years, $122,000. Everything above that is compounding doing what compounding does in the later years. Accelerating. No debt, no tenants, no late-night emergencies. By year 20, they've arrived at roughly the same place in terms of net worth, somewhere between $400,000 and $500,000 each, but the paths could not be more different. Alex worked for hers. Jordan waited for his. Now let's look at what stocks get wrong, because the honest version of this comparison has to include the downsides of both. Volatility is not just a number in a textbook. In 2008, the stock market dropped 37%. In March 2020, it fell 34% in a single month. If Jordan had $150,000 in his portfolio and watched it drop to $95,000 in a matter of weeks, that is not abstract. That is gut-wrenching. And the data is clear on what most people do when that happens. They sell at the bottom and buy back after the recovery, locking in the worst possible outcome. The behavioral risk of index investing is real, and it's the part most stock advocates skip over. There's also no cash flow. A total market index fund pays dividends of around 1.3 to 1.5% per year in 2026. On $200,000, that's roughly $2,500 to $3,000 annually. That does not replace anyone's income. Real estate sends you a check every month, or at least it should if the numbers actually work. And that monthly cash flow has psychological value that shows up nowhere in a portfolio statement. And there's no leverage equivalent. Jordan used $50,000 to control $50,000. He can't borrow against it in the same way to amplify his returns on the upside. But here's what the real estate case often leaves out. Stocks have delivered average annual returns of around 10 to 12% over extended periods. Real estate provides more stable appreciation averaging 4 to 5% annually, supplemented by rental income. Those numbers look close until you factor in the time, the stress, the debt, and the concentration risk that comes with owning a single asset. A real analysis published in 2026 tracked an actual condo purchase against the same dollars invested in a stock index over 10 years. The $71,000 invested in the stock market over that same period delivered an ending balance of $296,000, a total return of 15.3% per year. The property delivered significantly less on a like-for-like comparison when all costs were included. So which one is actually better? Here's the honest answer. It depends on you, but not in a vague cop-out way. It depends on specific, identifiable things. Real estate wins if you're in a market where the rent-to-price ratio is strong, where monthly rent is at least 0.8 to 1% of the purchase price. That's where the cash flow math actually works from day one. It wins if you're willing to treat it as a business, not a side hustle. Screening tenants carefully, budgeting for capital expenditures every month, building systems, taking the management seriously. It wins if you use strategies like house hacking, living in one unit of a multifamily property and renting the others, which can reduce your housing costs to near zero while building equity. That's something the stock market simply cannot do. And it wins if you understand tools like the 1031 exchange, which lets you defer capital gains taxes by rolling profits into a new property. A tax advantage stocks can't replicate outside of retirement accounts. Index funds win if your time is genuinely valuable to you and you don't want a second job that doesn't pay by the hour. They win if you value liquidity, being able to access your money without a 30 to 60-day sale process and thousands in transaction costs. They win if you can manage the emotional side of volatility without panic selling. And they win through pure simplicity, as the same investment that outperformed most professional money managers over the last 20 years requires nothing but consistency. Here's the part that changes everything, and most videos don't mention. The people with the most wealth almost never chose one or the other. They started with one, built equity or capital, and used it to access both. The real estate investor who builds equity and eventually refinances into more properties. The index fund investor who eventually uses gains to add a rental property when the numbers actually work. The house hacker who eliminated housing costs entirely, invested the savings, and ended up with both an asset and a growing portfolio. The two strategies aren't rivals, they're tools. And the investors who understand both and use each one where it actually fits their situation and their market are the ones who look back in 20 years and realize they didn't have to choose. The real mistake isn't picking real estate, and it isn't picking stocks. The real mistake is picking either one based on a YouTube video, a podcast clip, or someone at a dinner party without running the full numbers for your own city, your own situation, and your own time. Because the version of this comparison that includes everything, every cost, every hour, every risk on both sides, is the only version that actually tells you the truth. And now you've seen that version. If you're wondering which path fits your situation better, or what the math looks like if you try to do both at the same time, let me know in the comments. Drop where you're at, team real estate, team stocks, or trying to figure out how to do both, and I'll read through them. And if you want to see the next video where we look at how to actually build wealth using both strategies together, make sure you're subscribed so you don't miss it.